Title: The Debt Engine Quietly Driving the Global Financial System. Dramatic hook: imagine waking up tomorrow and discovering that almost every country on Earth owes money. Not just small debts, but trillions upon trillions of dollars. Now here's the strange part. If every country is in debt, then who exactly is the creditor? Who is sitting on the other side of this massive global ledger? Governments borrow, corporations borrow, households borrow. Even central banks themselves operate inside a system built entirely on credit. And yet the global debt number keeps growing. In fact, global debt has already passed $300 trillion. That's more than 3 times the entire world's economic output, which raises a disturbing question. What kind of system allows debt to grow faster than the economy forever? And more importantly, what happens if that system ever stops? To understand that, we have to look at the hidden mechanism quietly powering the global economy. A mechanism many people never notice. A mechanism that could be described as the debt engine. Setting the stage. The birth of a strange system. Money once meant something simple. Gold, silver, real physical assets that existed in limited supply. For thousands of years, economies operated under this principle. If a government wanted more money, it had to mine more gold or acquire it through trade. This created a natural limit. You couldn't just invent wealth. But in the 17th century, something revolutionary happened. Goldsmiths in Europe began storing people's gold in vaults and giving them paper receipts representing that gold. Those receipts became easier to trade than the gold itself. Soon people realized something. Most depositors never came back to withdraw their gold at the same time. So goldsmiths started issuing more receipts than gold they actually held. They had invented something incredibly powerful: fractional reserve banking. Money was no longer just stored. It could now be created through lending. And with that discovery, the foundations of the modern financial system were born. Origins of the debt engine. At first, this system seemed harmless. Banks issued loans, businesses expanded, trade increased, economic growth accelerated. But there was a hidden twist inside this system. When a bank issues a loan, it doesn't hand out existing money. It creates new money through the loan itself. But here's the critical detail. The borrower must repay the loan plus interest, which means the system constantly demands more money than currently exists. The only way to solve this mathematical problem: more loans, more debt, more money creation. The system must continuously expand, like an engine that cannot stop running. The rise of the global debt machine. For centuries, this system grew slowly, but everything changed in the 20th century. 2 world wars reshaped the financial order of the world. In 1944, world leaders met at a conference that would define the modern economy, the Bretton Woods Agreement. This system tied global currencies to the US dollar, and the dollar itself was linked to gold. At first it created stability, but there was a problem. Governments quickly realized that controlling money meant controlling the economy. And controlling the economy meant controlling power. Over time, governments began spending far more than they collected in taxes. Instead of raising taxes, they chose an easier option: borrow and borrow and borrow again. By the 1960s, the United States had issued far more dollars than it had gold to back them. The system was approaching a breaking point, the breaking point. In 1971, a quiet decision changed the global financial system forever. The United States ended the convertibility of dollars into gold. The world entered the era of fiat money, money backed by nothing but government trust. From that moment forward, the debt engine gained a new level of power. There was no longer a hard limit on money creation. Governments could borrow more, central banks could print more, banks could lend more, and global debt began to grow faster than ever before. What used to take centuries now happened in decades. And what took decades now happens in years. The fallout of endless debt. At first, the system looked like a miracle. More credit meant more spending. More spending meant more economic growth. Stock markets rose. Housing prices exploded. Consumption increased. But debt has a strange property. It creates growth today by borrowing from tomorrow. Eventually, tomorrow arrives, and the bill comes due. This has happened again and again. The Latin American debt crisis of the 1980s. The Asian financial crisis of 1997, the global financial crisis of 2008. Each time the same pattern appears. Debt builds quietly for years. Confidence grows, risk increases. Then suddenly something breaks and the entire system shakes.
Failed fixes. After every crisis, governments promise reform.
New regulations, stronger oversight, safer banking,